In today's video, we will explore everything that there is to know about trend lines. After this video, you will have a complete in-depth understanding of what trend lines are and how to use them. But before that, make sure to click the subscribe button and hit the notification bell so you'll be the first to know when I publish new content. First up, why should you even consider using trend lines? Trend lines are among the most basic of our technical tools, but they're also one of the most powerful. They are a fundamental building block of pattern identification and interpretation, because nearly all patterns require the use of trend lines to construct them. Just take a look here. I have plotted in a channel. These trend lines here, they showcase that a possible pattern is in play. A descending rectangle. Let's take a look at the second reason for using trend lines. Trend lines act as a dynamic support and resistance areas, as well as demand and supply areas, and therefore a good trend line should reflect the underlying trend. Take a look here. This here bounced off this area, bounced off this area, bounced off this area, then broke out and started bouncing here. So these areas, they serve as strong as good dynamic support and resistance areas. And every time price swings back up and bounces off these areas, these levels are reaffirmed as a dynamic level of support and resistance. So buying when the price falls to an uptrend line and selling when the price rises to a downtrend line can make sense if utilized intelligently. If the support resistance zone is violated though, as we see here where it is broken, a low risk stop can't be put just above the line or below the line, depending whether it's an uptrend or a downtrend. Before we continue, trend lines are not signals to buy or sell, but rather are intelligent places for anticipating price movement. Trend lines, they are ideal for understanding where the underlying trend lies and act as a dynamic demand supply area. Okay, and they should be used for this purpose and in combination with other tools to build a solid strategy. Trend lines alone cannot provide you with a solid edge. Don't trade indicators or other trading tools in isolation. Use the power of confluence to heighten the probability of your trades, because that's what trading is about. It's about probabilities, not certainties. Okay, let's take a look at the third reason. So, when a trend line is broken, it triggers some specific signals. Let's take a look at what happens. So we have an uptrend here, and we have a trend line here. So, when this breaks, the following thought process should trigger in your mind that either we have a bigger correction here, followed by a continuation of the trend, or when this break happens, we might get a correction here, but it reverses. The third option is that price just simply reverses and goes lower and lower and lower. These three scenarios can happen, but unfortunately, there's no way of telling at the time of the break which scenario will prove to be the outcome. But we can still put intelligent trades with high probability based on the market data that is present. Okay, let's take a look at some of these market data or clues. The angle of ascent or descent of the trend line might provide a clue, or one clue. Sharp angled trend lines like this have a tendency to be followed by a consolidation rather than a reversal, since they are less sustainable. So if a sharp angled trend line like this breaks, it's more likely to make a continuation correction and then continue than actually reverse, because of the unsustainable character of this sharp trend. Another clue would be that if a series of higher highs, here higher highs are followed, or higher highs and higher lows are followed or accompanied by progressively lower volume. So we have a volume here, then there's some lower volume and a bit lower volume and a bit lower volume. This is a clear case of divergence. This indicates that progress is slowing down, since the volume is no longer going with the trend. In this instance, a break of the trend line here would likely be more substantial than if the volume had increased with each rally. Okay, these are just some of the clues and tools that one can use to assess the market width and to assess what a trendline break means. Later in the video, we will look in more detail at trendline breaks and how to assess whether a trendline break is meaningful or not. Okay, now let's take a look at the fourth reason and the last reason. This reason is related to pattern identification. How trendlines help identify patterns and possible pattern scenarios. So when a trendline breaks, it triggers you to look for possible pattern scenarios. If we have a trend here, we got a trend line, we get a trendline break, then this triggers you to look for possible pattern scenarios, because you know that either a correction to continue the trend can happen, or a correction to reverse the trend can happen, or a reversal here can happen without any real substantial correction. So you start looking for clues and patterns as to which direction the trend will go when a break happens. So now that you know why using trend lines can be helpful, we will take a deeper look at what trend lines are and how to use them. What is a trend line? A trend line is a straight line connecting a series of higher lows in a rising market, in an uptrend. Look here, we have an uptrend. Market is pushing up and it's correcting. It's pushing up, it's pulling back, it's pushing up, it's pulling back, and it's pushing up. So every time market pushes up, a higher low was created. And a trend line is then connected at the higher lows, which make this a clear uptrend. In a descending market or a downtrend, the lower highs are connected by a straight line. So if this was a downtrend here, like so, then you would connect a trend line at the lower highs, which is right here. This is a lower high, and this is a lower high. How to draw trend lines? Okay, let's take a look at how to draw trend lines. To be considered a valid trend line, a trend line must connect two or more highs or lows, depending on an uptrend or a downtrend. Otherwise, it will be a line drawn in space with no meaning. If you don't connect dots and you just plot in a trend line like this, then there's no meaning to it. And people frequently draw lines that touch only one point even. And if you just touch one point like so, this cannot be considered a valid trend line, because such a trend line conveys the idea that they have some significance just because they appear on the charts. This is a crucial element to remember, since a valid trend line is a graphic representation of the underlying trend. As a result, a line that touches only one point cannot be considered a valid trend line. So remember, it has to touch, or it has to connect two or more highs or lows depending on the trend. Now let's take a look at primary and secondary trends. You should constantly be asking yourself, which line better reflects the underlying trend? Okay, this is especially true if you are an intraday trader. Take a look at this chart here. So a primary trend would be the first low of the structure. So if this is the structure, and this would be our first low if this is the data we have. So we would plot this in. Just gonna plot it like this. Don't mind that it's not perfectly symmetrical, right? So the ascent in this scenario is relatively modest, right? The trend is moving modestly. It's not going in a crazy fashion. But then suddenly the price rallies sharply and it just goes and it moves away from this trend line, quite far away. and therefore a break of the trend line would happen very late after the price reaches a top. So take a look. When this comes down, it will happen late. So this would be a late signal. So therefore it's wiser to redraw the line as the price rises in such cases, because this clearly reflects the underlying trend better. Let's delete this here so we can get a clearer example of what I'm talking about. Delete. So we have a trend. It goes like this. Then suddenly price starts going quicker and away. It's moving away from this trend line. Therefore, a secondary trend line makes sense. You would draw that here, because this secondary trend line, it better reflects the underlying trend. And when a break happens, you get the signal much earlier than if you would have to wait for a price to reach all the way down to this trend. So in conclusion, you always need to connect at minimum 2 highs or 2 lows. This here and this here. Always connect minimum of 2. So let me put this trend line where it's supposed to be. Another element of drawing trend line is whether to do so at the end of wicks or the candle's body. So I have scoured trading books and the internet, and this is the conclusion that I have come to. Both ways of drawing trend lines are acceptable. It more comes down to the instrument you are trading, because all instruments move differently and are unique in their own way. So test both methods of drawing trend lines and extrapolate from the data that you acquire what makes the most sense to you, or what makes the most sense. Take a look at this example here on natural gas. If you were to draw the trend line at the end of the wick here, then it would look like this. And you see there's no touching here. The price never really comes down to this area. But if you choose to do it at the body of the candle's body, then it's a different story. Now suddenly price comes down to the trend line and bounces off the trend line. Okay, so most people, when they see a trend line break, they deduce that the trend has changed and they forget about it. Like so. You get a break of the trend here and you forget about it. But that is a mistake, since an extended trend line can be as vital as a broken trend line. The price will typically bounce back to the extended line when an uptrend line is broken. This is known as the throwback move. So price breaks out, and then the throwback move often happens where it comes back to the extended trend line and bounces off from this point, because this area has previously served as a dynamic support area. Now it's a dynamic resistance area. So be aware of extended trend lines, because these trend lines can be used as intelligent areas from where we can anticipate some kind of movement. These areas can be used, for example, as profit take areas, or areas where you consider adjusting your trade because of this dynamic supply and demand area. It's also a good idea to draw parallel lines to the basic trend line. What do I mean by that? I'm talking about trend channels. Take a look, okay? The parallel line is known as the return line, and it unites the top of rallies in a rising market. So these are the tops, and these are the ones you would connect. And the return line joins the series of bottoms in a down market, okay? A trend channel is an area between these two trend extremes, as you see right here in this example. And why is the return line a good thing, or why is it beneficial? It's beneficial from two perspectives. First, depending on the trend's direction, it represents a support zone or resistance zone. Secondly, and probably more importantly, a break of the return line indicates that either the trend will accelerate or at least temporary reversal in the primary trend will occur. So if we see a break of this channel, it could either start accelerating or a temporary reversal in the primary trend could occur. This is essential information that you can use to again adjust your trade as needed. For instance, taking partial profits, moving stop losses, or considering adding to a trade. So let's take a look at yet another example here. So we have this trend channel and the price comes up and breaks out of this return line up here, and in doing so it starts trending up here and creates a new channel up here above the return line. So this here was a breakout trade out of the primary channel. This here could be a particular play, a trading play in your own trading book. Okay, let's look at another key concept that's important to know and understand. Here I'm talking about exhaustion. Exhaustion comes into play especially when the trend channel is much steeper and we at the same time get a break of the return line. So what do I mean by that? Let's take a look here. If the price fails to hold above the return line, if it comes up and then it cannot hold these areas, these levels, but quickly comes down again, it indicates a probable trend reversal. This is often the case if the break is accompanied by a high volume as well. In general, the steeper this channel, the more probable the breakout will be an exhaustion move. So if we have a channel that is way steeper, something like this, and we get a break of the return line, and an increased volume, there's a high probability that the trend will reverse. Exhaustion can also occur when a price rallies briefly above or below a normal trend line. Okay, so if you just take away the return trend line here, and if it comes down, and the same also applies here. Exhaustion also applies in this case with a normal trend line. This brief break often indicates that this prevailing trend here still has strength and can run much further. Another element is that exhaustion moves also pose a challenge in how a trend line should be created. Look at this example here, okay? We have an exhaustion move right up here. I'm just gonna delete this part quickly, like that. So drawing the line at the top of the break, right? So if this continues, and we draw the trend line now at the top of this break, is technically correct, but common sense tells us that the original line better indicates the underlying trend, because after all, it had touched many times before the exhaustion, right? It had been touched, like, look, let's take a look at this. 1 time, 2, 3 times, whereas this redrawn line has only been touched twice. So an exhaustion move actually adds credibility to the trend line when you think about it. This is because the price violates the line, but this line is so significant as a support resistance area that the price is unable to hold the break. See here? In this case, it's a very significant demand area. Trend lines are not to be just viewed as a line, but more so as a dynamic area where demand and supply lies. Because if this here was not an effective barrier, the break would have held and there would have been no exhaustion move. The price would have just fallen and sellers, they would have won this supply and demand battle. But it did hold, and it did create this exhaustion move, and because of that, as a result of that, this signal becomes even more powerful when the price actually makes a valid break out of this trend line. So in conclusion, when drawing the trend line, this line here is still a very productive line to have. It's a significant line to have because it has been touched many times, and even though this might be technically correct to draw it at this new low now, this line still stands to reason that this is a very effective trend line, especially because of this exhaustion move. It adds credibility, right? Because we didn't just break below the trend line, but we bounced off of this trend line. So before we go into the last lesson of today, we need to look at another critical point here. Experimentation will reveal that each instrument has its own character, with some responding well to these trendline techniques and approaches and others not at all. Therefore, make sure to test and gather data before you apply any trading knowledge or tool. Okay, it's your responsibility to ensure that no matter what you do here in life, you're well prepared and understand the risks. Okay, let's take a look at the importance of a trendline break. Now that we know that a break in the trendline results in either a bigger correction followed by a continuation, a correction followed by a reversal, or simply a reversal, right? A slowing in the pace of the trend. We don't know which outcome will develop, but we have some guidelines that can help assess this. So here are 3 factors that will help in assessing this. The length of the line. The longer the line, the more meaningful the trend line is. Okay? A trend that extends for a year is more significant than a trend that goes for 1 week. Big trends result in big signals. Small trends in small ones. Number 2 is the number of times the trend line has been touched or approached. This determines its significance. The higher the number, the more significant it is. And this is because a trend line represents a dynamic area of support and resistance. A move close to the trend line is almost as meaningful as touching it because it reflects the line's importance as a support or resistance area. So when price approaches it but it doesn't touch the line, that is still very significant. Because remember, we are looking at this as an area of supply and demand, support and resistance, not a static line. And the extended line is as equally crucial because extended lines, they reverse their support resistance role. For instance, if a solid uptrend has been broken, like so, a break happens, then the price is now below this line here. There's a probability that the price will find resistance at this line, which has previously been support. The very last factor is about angle of ascent or descent. So a very sharp trend is difficult to maintain, something that goes very sharply and can easily be broken. All trends will eventually be broken, but the steeper ones are more likely to do so faster. And the break of a steep trend like this one has less impact than the break of a more gradual trend. There's usually a brief corrective movement before the trend starts to resume, but at a much slower and more sustainable pace. Okay, so a break in a steep trend line usually signals a continuation rather than a reversal. And this is because, remember, it's less sustainable, something that just goes extremely quickly at a high pace. It's not durable, so it will break. And when that happens, More often than not, it's actually a correction that will form. The pace of the trend slows down. So these are the three factors that can help in determining the importance of a trendline break. Look at them as clues to when you are analyzing and when you are assessing a trendline. Okay, that's it for today. I hope that you got a lot of value out of it. Please comment down below what you think. And if you want to support this channel, please subscribe and like. So, be better today than you were yesterday. Bye bye.